Imagine 19,646 people. Each opens a brokerage account. Each commits to day trading for at least 300 days. They study charts, they watch the news, they develop strategies. They tell themselves they will be the exception. 3 years later, the data comes in. Of those 19,000 traders, disciplined, persistent, all in, 97% lost money. Only 1 in 200 earned more than a starting bank teller's salary. This is not a story about willpower, it is a story about a formula. There is an equation that runs through every single trade, and the equation, on average, points down. Day trading sells itself with 3 things: a chart, a screen, and a story. The chart shows volatility. Volatility looks like opportunity because every wiggle is a potential win. The screen pulses with red and green and order flow, which feels like information. And the story, the one any aspiring trader hears the first week, is that with enough screen time and the right strategy, anyone can extract a living from the market. The pitch is intuitive because it borrows from honest skill domains. In chess, the better player wins more often. In poker, played long enough, the more skilled hand wins on average. In day trading, the implied claim, the same logic applies. Patient analysis plus pattern recognition plus risk management equals a measurable edge. It almost makes sense, except it isn't a chessboard, and it isn't a poker table, and the house isn't the broker. In a chess game, the board does not move while you think. In a poker hand, the cards are finite and the rules of the deck are fixed. In a market, the price is generated by the collective decisions of everyone trading at the same time as you, including, increasingly, algorithms that execute thousands of orders per second. You are not the player. You are one bet inside a multi-billion-dollar simulation that does not know you exist. There is one more thing the pitch leaves out. In chess, both sides start equal. In poker, every player at the table pays the rake, but they pay it once per hand. In day trading, you pay the house, the cost of being in the market, every single time you click. The cost is the bid-ask spread, the commission, the slippage, the tax. Multiply that small cost by hundreds or thousands of clicks per year, and the small becomes the dominant force on your account. Frequency is the multiplier. Edge is what's left. And the math, once you write it down, is unambiguous. Before the math, a quick word. Today's episode is sponsored. The sponsor, a private community for people who'd rather understand the equation than guess the chart. Inside, we work through deep dive material on risk management, market microstructure, and the behavioral traps that turn smart people into negative EV traders. If this episode lands, the risk management and microstructure tracks inside go a layer deeper. Find the link below, right under the video. Now, back to the formula. Let's put it in symbols. The expected value of a single trade is the sum of each possible outcome multiplied by its probability. For a binary trade, win or lose, that gives expected value equals the probability of winning times the average win minus the probability of losing times the average loss. Standard probability theory, casinos use it, insurance companies use it, hedge funds use it. Now plug in numbers a hopeful trader might believe about themselves. A strategy that wins 55% of the time with average wins of $100 and average losses of $90. That looks profitable. $14.50 per trade in expectation. Multiply by, say, 5 round trips per day, 252 trading days per year, and you have $18,270 of expected gross profit. Not bad on, say, a $50,000 account. Except this is gross. Now bring in the costs. A round trip on most retail platforms costs about $4 in commissions, $3 in bid-ask spread, and $1 in slippage. $8 per trade in friction. Subtract that, and the per-trade expected value drops from $14.50 to $6.50. Still positive, still tempting, until taxes. Short-term capital gains in the United States are taxed as ordinary income, between 22 and 37%. After tax, that strategy returns roughly $4,800 per year on a $50,000 account, about 9.6%. Now compare that to a passive index fund earning 7% real, with no work, no stress, and an expense ratio of 3 cents per $100 per year. Now drop the win rate by 4 percentage points, from 55 to 51. The expected value after costs falls from $6.50 per trade to a loss of about $1 per trade. 4 points. That's the entire fragility budget. A trader who is 51% right instead of 55% right is now paying the broker every single click. The strategy was fragile. The math doesn't care how disciplined you are. It cares about probabilities, costs, and frequency. And frequency is the multiplier. Here is the part the brain refuses to absorb. Day trading feels like a skill domain. There is effort, there is practice, there is a learning curve, there are losses that feel like lessons, there are wins that feel like proof. The whole experience is wired to register in your nervous system as deliberate practice toward mastery. But your brain has been trained on the wrong reference. It learned skill in environments where the world doesn't move while you think. A chessboard, a piano, a tennis court. The rules of those games are stable. Your improvement compounds against a fixed challenge. Effort plus reps equals progress. The market is not stable. The market changes its rules every microsecond. The price you see at 3:15 and 22 seconds is generated by the collective adaptive behavior of everyone else trading at 3:15 and 22 seconds, including algorithms that retrain themselves on your trade as you submit it. Effort doesn't compound here, it dissipates. Daniel Kahneman called this, "We are blind to our blindness." Your brain cannot tell from the inside whether it is in a stable skill domain or an adaptive one. It uses the same circuitry to learn both. So a string of 3 winning trades feels exactly like a string of 3 solved chess puzzles. The signal you experience is identical. There is something else worth naming. Day trading hijacks the exact same dopamine pathway that powers slot machines. Variable reward schedules, the kind that drop a payoff at unpredictable intervals, are the most addictive reward structure ever measured in animal psychology. A win after several losses releases a stronger dopamine signal than a steady, predictable win. Your brain, evolutionarily, treats the rare green candle the same way it treats finding fruit on a tree it had checked yesterday. The reward is more compelling because it was uncertain. The signal is wrong. The reward circuit is wired to chase it anyway. And the math doesn't care that the signal is wrong. 4 studies, 4 datasets, 4 continents worth of traders. One conclusion, case 1, the United States, 1991 to 1996. Brad Barber and Terrence Odian obtain account data for 66,465 households at a large American discount broker. The most active traders, the top quintile by turnover, earn 11.4% annually. The market over the same period returns 17.9%. The shortfall, 6.5 percentage points, is explained almost entirely by transaction costs and bad stock picks. Barber and Odian published their finding in the Journal of Finance in 2000. They title the paper simply, "Trading is Hazardous to Your Wealth." Case 2, same data, gender lens, 2001. Barber and Odian partition the same population by gender. Men trade 45% more than women. Single men trade 67% more. After adjusting for risk, men earn 1.4 percentage points less per year than women. Single men earn 2.3 percentage points less than single women. The pattern holds across age, account size, and stock picking ability. The traders who think they are best at it are, on average, the ones losing the most. Case 3, Taiwan 1992 to 2006. 15 years of data covering virtually every day trader on the Taiwan Stock Exchange. Barber and 3 co-authors find that fewer than 1% of day traders predictably and reliably earn positive abnormal returns net of fees. 80% quit within 2 years. The poor performers quit faster, but the population of successful persisters is so thin that statistically, the rational thing to do is not start. Case 4, Brazil, 2013 to 2015. Fernando Chag and his co-authors at the University of São Paulo obtained Brazilian SEC records for 19,646 individuals who began day trading mini Ibovespa futures contracts and persisted for more than 300 days. 97% lost money. Only 1.1% earned more than the Brazilian minimum wage. Only 0.5% earned more than the starting salary of a bank teller. The authors close their abstract with one sentence. We find no evidence of learning by day trading. Different countries, different decades, different brokers, different regulators, same equation, same direction. The hardest sentence in this episode is this one. The 1% of day traders who succeed are not the disciplined ones. They are not the ones who studied harder. They are the cross-section of skill across the entire population of day traders. That population includes ex-prop shop quants, ex-market makers, PhD mathematicians who left finance, algorithmic specialists with custom-built order rotors, obsessives with 20 years of screen time and direct broker connections. You are not competing against your friends who tried it for a weekend. You are competing against that distribution. And inside it, the median outcome, the one applicable to everyone, including you, is a loss. The structural answer is the haystack. John Bogle, who founded Vanguard and invented the index fund in 1976, captured it in one line. Don't look for the needle, just buy the haystack. The haystack is not exciting. It does not give you a screen full of green candles to admire. It gives you on average the entire market's return, about 7% real, before any clever choice on your part. The Vanguard S&P 500 ETF, ticker symbol VOO, has compounded at nearly 10% nominal, about 7% real, for 30 years. Its annual cost, 3 cents per $100. 3 cents. Compare that to the $8 per round trip a day trader pays. Over a year of typical activity, say 1,260 round trips on a $50,000 account, a day trader pays roughly $10,000 in friction. Vanguard's index fund, on the same account, charges $15. The ratio is more than 600 to 1. The day trader is paying 600 times more in real money to chase a result the math says, on average, will be worse. The math does not punish you for not picking, because you aren't picking. It rewards you for staying still while the system pays you for time. That is the haystack. So here's the question every honest analysis of day trading eventually arrives at. When does trading become gambling? The mathematical answer is clean. Trading becomes gambling at the moment your net expected value, after commissions, spread, slippage, and tax, turns negative and you keep playing anyway. That's it. That's the whole rule. There is no skill threshold above which gambling mysteriously upgrades into investing. There is only the EV equation, run honestly, and the discipline to walk away if it points the wrong direction. Most retail traders cannot run that calculation honestly because the calculation requires admitting that the win rate they see is dressed up by survivorship bias. Every social media trader who shows you a $30,000 week had 99 peers who did not post. The visible distribution of trader outcomes is the right tail of a left-skewed distribution. The full distribution, the one that includes everyone who deleted their account, deleted their channel, or simply went quiet, is mostly negative. The honest version of the question is not, can I beat the market? It is, what am I willing to pay in real money to find out whether I am one of the rare ones? A roulette wheel is honest about that price. A trading screen, with its volatility and its candlestick patterns, is not. So the question is not whether you can be in the 1%. The question is what you owe yourself for the 99% of the time you are not. 3 episodes ago, we built the Rule of 72, compound growth, the curve climbing upward. 2 episodes ago, we mirrored it, inflation, the curve falling downward. This episode is a third axis, not up, not down, sideways. The shape of the distribution itself, most outcomes losses, a thin tail of wins, a structural left skew built into the cost mechanics of frequent trading. Compound moves money up, decay moves it down, variance moves it sideways. 3 exponents, same number, E, at the heart of all 3. The retirement plan that survives all 3 is the one that pays the lowest cost to be in the system, not the one that tries to outsmart it. Day trading is the most expensive way to lose to the market. The market does not have to win against you for you to lose. It only has to keep being itself while you pay the cost of attending. Next episode, we will look at what happens when you try to measure skill against variance. the Sharpe ratio, and the trap inside it. When does a streak of wins actually mean a strategy works? And when is it just the right tail of a left-skewed distribution refusing to admit what it is? Until then, watch the distribution, not just the candle.